Hey everyone, and welcome back to the Deep Dive. Today we are going to be going on a deep dive into the world of intelligent investing, and we're going to be using the book How to Think Like Benjamin Graham as our guide.
Oh, fantastic choice. I think Graham's principles are really timeless and, they're surprisingly accessible, even if you're not like a seasoned investor.
Right. You'd think a book about investing would be, dry and complex, but it's actually full of these engaging stories and analogies that really make these concepts click. But before we even jump into the specifics, I think it's fascinating how Graham kicks off the book. Kind of paints this picture of what he calls Q culture.
Yeah, it's such a striking image, isn't it? It's basically saying that, so many investors today are just completely obsessed with stock prices, like those constantly fluctuating numbers that we see on our screens, and they completely forget about the actual value of the businesses behind those stocks.
It's like you get caught up in the frenzy of an auction and you're just bidding higher and higher without even stopping to examine what you're actually buying.
Precisely. And that's where he introduces this brilliant analogy of Mr. Market, this manic depressive character who's always trying to buy or sell your business, based on his crazy mood swings, not on the actual value of the business itself.
So instead of making rational decisions based on careful analysis, people are letting their emotions and just the whims of the market dictate their investment choices.
Exactly. And that's the first trap that Graham wants us to avoid.
Right.
Right? Don't let Mr. Market with his crazy emotional roller coaster lead you astray.
Yeah.
Instead, take a step back. Focus on understanding the true value of a business before you even consider the price.
Okay. That makes a lot of sense.
Mm-hmm.
But how do we even begin to determine the true value of a business? I mean, it sounds pretty daunting.
Well, that's where he introduces another one of his really powerful concepts. The circle of competence. So he basically argues that, everyone has areas of expertise, industries or types of businesses that they just understand well.
So, for example, someone who's worked in the fashion industry for years, they'd have a pretty good grasp of, what makes a clothing company successful.
Exactly. They'd understand the trends, the supply chains, the challenges and opportunities in a way that someone outside that industry just wouldn't. And Graham's advice is basically to stick to investing in areas where you have that deep understanding.
So even if there's a lot of buzz around a particular sector, like, say, renewable energy, if I don't really understand how those businesses work, I should probably steer clear.
Yeah, that's the wise approach. Venturing outside your circle of competence basically turns you from an investor into a speculator. You're relying more on luck than knowledge at that point. And Graham reminds us that, the odds rarely favor the gambler in the long run.
That's a good point.
Yeah.
Okay, so even if we stay within our circle of competence, though, the market can be so unpredictable. How can we make intelligent decisions when stock prices are just constantly bouncing up and down?
Well, that brings us to another crucial insight from the book, understanding market volatility and its various causes. So Graham actually challenges a really popular theory in finance called the efficient market theory, or EMT. Have you heard of that one?
I have. It's the idea that stock prices always reflect all available information. So it's kind of like this idea that you can't really beat the market.
Precisely. But Graham argues that this theory is a huge oversimplification. It ignores the very real ways that human psychology and emotions like fear and greed can just drive prices far away from a company's true value.
So it's not always about, perfect information flowing efficiently through the market.
Yeah.
Sometimes it's just Mr. Market having a bad day and driving prices down for no rational reason.
Exactly. And Graham breaks down market volatility into different types to kind of help us understand these dynamics. So there's positive information volatility, which is, when prices react to genuine good news about a company like a breakthrough product or a surge in profits.
Okay, that makes sense.
Yeah.
But what about when the opposite happens, when bad news or rumors send prices tumbling?
Yeah, that's what he calls negative information volatility. And, this has become even more potent in today's world with this constant stream of information and honestly misinformation online.
Right, it feels like a single tweet or a viral post can just send a stock spiraling downward, even if the information is completely unfounded.
Exactly. That's why it's, more important than ever to be discerning about your information sources.
Yeah.
Don't just blindly follow the headlines. Dig deeper, verify the information, and, keep your eyes focused on the long-term prospects of the business.
Okay, solid advice. So we've
right.
got positive information volatility, negative information volatility. Is there another type?
Yes. The third type that Graham identifies is trader volatility. And this one is all about the actions of traders themselves.
Okay.
So it's this idea that stock prices can fluctuate wildly, not because of any real change in the company's value, but simply because traders are just trying to make a quick buck.
It's almost like a self-fulfilling prophecy. Traders see a stock going up or down, they all jump on the bandwagon, and they push the price even further in that direction, regardless of the underlying fundamentals.
Precisely. And Graham argues that this type of volatility has only intensified, with the rise of high-frequency trading and these algorithms that buy and sell stocks in fractions of a second, often amplifying, those really short-term swings.
Okay, so we've got these three types of volatility to contend with: positive information, negative information, and trader volatility. It seems like navigating the market is like walking through a minefield.
It can definitely feel that way, especially if you're letting Mr. Market dictate your every move. But remember, our goal here is to learn to think like Benjamin Graham,
Right.
to focus on value, not price, and to stay within that circle of competence.
Okay, that'll make sense. But I guess the fundamental question that we're still left with is, how do we actually determine the value of a business?
Right. Well, that's where Graham gets really creative. To illustrate this point, he uses this wonderfully engaging story about an old man who's selling his apple tree.
Okay, I'm intrigued. Tell me more about this apple tree.
So imagine this old man has an apple tree that produces these delicious apples every year.
Okay.
And he wants to sell the tree, but of course he needs to figure out what it's worth.
Yeah, sounds like a classic business dilemma. So how does he go about valuing his apple tree?
Well, one approach is to look at the tree's book value, which is basically its net worth. So, you'd add up the value of its assets, the trunk branches, roots, maybe the land it's on, and then you subtract any liabilities, like maybe the cost of fertilizer or tools.
Okay, so that's one way to look at it. But is that the only way to value the apple tree?
Definitely not. Another method is to focus on the tree's earnings.
Yeah.
So how much money the old man makes each year from selling those delicious apples.
So instead of just looking at the tree itself, we're kind of considering its income-generating potential.
Exactly. And then there's a third approach called the discounted cash flow method. This one's a bit more complex, but it basically involves looking at the tree's future cash flow, so how much money it's expected to generate over its remaining lifespan, and then discounting those cash flows back to their present value.
Okay, I'm sensing a pattern here. It seems like valuing a business kind of involves looking beyond the surface and really understanding its ability to generate income over time.
You're catching on quickly. And, the story of the apple tree highlights another one of Graham's crucial concepts, which he calls the margin of safety.
Margin of safety.
Yeah.
Okay, I'm all ears.
Yeah.
Tell me more about that.
So it's basically the idea that you should always aim to buy a business at a price that is significantly lower than your estimated value.
Okay.
So it's like building in this buffer to protect yourself in case your valuation was too optimistic or if unexpected events occur that could hurt the business.
So it's kind of like a financial cushion in case things don't go exactly as planned?
Exactly. And this margin of safety is really crucial because as we've been discussing, valuing a business isn't like this exact science. There's always a degree of uncertainty involved.
Okay, that makes sense. So we've got these different valuation methods: book value earnings, discounted cash flow, and this crucial concept of a margin of safety. Is there anything else we need to consider when we're kind of evaluating a potential investment?
Yes. And this is a factor that I think often gets overlooked. Graham really stresses the importance of carefully evaluating the management of a business.
Management. Okay. Yeah, makes sense. Even the best business idea can crumble if the people running it aren't competent or trustworthy.
Precisely. You really need to assess whether the management team is trustworthy, skilled, and, aligned with the interests of the shareholders.
So what are some red flags that we should be watching out for?
Yeah. Well, one big warning sign is executive compensation structures that incentivize short-term gains over long-term value creation. So, for example, if a CEO is heavily rewarded for hitting short-term earnings targets, they might be tempted to make decisions that, boost profits in the short run, but actually end up hurting the company in the long run.
Right. It's like squeezing all the juice out of the apple tree today without caring if it bears fruit tomorrow.
Exactly. Another concern is a lack of transparency. So, if management is kind of evasive, hides information, or engages in these questionable accounting practices, that's a huge red flag.
So it's not just about crunching the numbers. It's about really understanding the people behind the business and how they operate.
Absolutely. Graham argues that evaluating management is just as important as analyzing the financials, maybe even more so.
Wow, this is all starting to come together. We're really learning to think like Benjamin Graham, to focus on values, stay within our circle of competence, understand market volatility, and carefully evaluate management. I feel like my investor brain is getting a real workout.
That's fantastic to hear. And believe it or not, we've only just scratched the surface of what Graham has to offer.
Really?
There's so much more to explore, and we'll dive even deeper into his insights in the next part of our deep dive. Welcome back to our deep dive into how to think like Benjamin Graham.
I'm really starting to see the world of investing through a new lens. We talked about the importance of focusing on value over price and staying within our circle of competence and understanding, the ups and downs of market volatility.
Yeah. And let's not forget about those insightful red flags for evaluating management. That was a real eye-opener for me.
Absolutely. But now I'm curious. Let's say I've identified a company that seems really promising. It's in a growing industry. Its revenues are steadily increasing. It's even starting to turn a profit. But the stock price has been on a real upswing lately. It's up, significantly in the last few months. What would Graham say about this situation?
I think Graham would remind us that a rising stock price doesn't automatically mean that the company is a good investment. Remember, Mr. Market, he can get a little carried away sometimes.
Right. We can't just chase hot stocks without really understanding the fundamentals. We need to dig deeper and kind of figure out if that price is actually justified.
Exactly. And that's where all of our analytical tools come in. We need to look at the company's financial statements, calculate those key ratios that we discussed, and try to determine, its intrinsic value, what the business is truly worth based on its earnings potential and its assets.
Okay, so let's say we've done all of our analysis, and we believe that the company's intrinsic value is significantly higher than its current stock price.
Yeah.
Does that automatically make it a buy?
Not so fast. Remember Graham's emphasis on the margin of safety?
Oh, right.
We need to be realistic and consider the possibility that, maybe our valuation's a bit too optimistic or that unexpected events could occur that, could impact the company's performance.
So even if we think a stock is undervalued, we should still aim to buy it at a price that's even lower, just to give ourselves that cushion.
Exactly. Think of it like buying insurance for your investment.
Okay.
That margin of safety really helps protect you from the inevitable uncertainties of the market.
That's a great analogy. Okay, so what about situations where a company's stock price seems completely out of sync with its fundamentals? Like, what if a company is generating solid earnings, has strong financials, but its stock price is just kind of languishing? Yeah.
That's where things get really interesting, and it's where I think Graham's philosophy can really shine. So remember, Mr. Market is driven by emotions, and sometimes he gets overly pessimistic.
So there might be times when the market is undervaluing a solid company for reasons that have nothing to do with the business itself.
Precisely. It could be due to, broader market trends, negative sentiment toward the industry, or even just plain irrational fear.
So if we've done our homework and we believe a company is genuinely undervalued by the market, that could be a fantastic buying opportunity.
Absolutely. It's like finding a hidden treasure that everyone else is overlooking because they're too focused on the short-term noise.
Okay, I'm starting to see the power of Graham's approach.
Yeah.
But what about the opposite scenario? What if a company's stock price is plummeting? Like they announce a string of disappointing earnings or face some unexpected challenges. What do we do then?
That's where discipline and emotional control become absolutely crucial. The first thing to do is avoid panicking.
Easier said than done sometimes.
I know, right? But remember, we're not trying to time the market. We're trying to find undervalued businesses.
Right.
So if a company's stock price is dropping, we need to take a deep breath, reevaluate the situation, and really figure out if the decline is justified or if it actually presents a buying opportunity.
So it's not about, blindly selling off our shares just because the price is going down.
Exactly. If the company's underlying fundamentals are still strong and the long-term prospects are still intact, the price decline might just be a temporary blip. In fact, it could even create a chance to buy more shares at a bargain price, which, would increase our potential returns down the road.
Okay, so we need to be discerning. A falling stock price isn't always a signal to sell. It might actually be a signal to buy more if the underlying business is still solid.
Precisely. And that's what I find so compelling about Graham's approach. It encourages us to think for ourselves, to be patient, and to focus on the long-term value of a business rather than getting swept up in those, short-term fluctuations of the market.
This has been such an eye-opening deep dive. We've covered so much ground from, understanding market dynamics to analyzing financials, evaluating management, and even navigating these real-world investing scenarios.
It's been a fascinating exploration for me, too. And I'm excited to see how we can apply these principles to our own portfolios.
Welcome back to the deep dive. We're wrapping up our exploration of how to think like Benjamin Graham, and I'm feeling like ready to put these principles into action.
Oh, that's great to hear. In this final part, why don't we explore some real-world scenarios and see how Graham's approach can kind of guide us in making smarter investment decisions?
Perfect. So Let's say I've been following this company that seems to have a lot of potential. It's in like a growing industry. Its revenues are steadily increasing, and it's even starting to turn a profit. But the stock price has been on a real upswing lately. It's up significantly in the last few months. What would Graham say about a situation like this?
I think Graham would first remind us that, a rising stock price doesn't automatically mean that the company is a good investment. Remember Mr. Market? He can get a little carried away sometimes.
Right. We can't just chase those hot stocks without understanding the fundamentals. We need to dig deeper and figure out if the price is justified.
Exactly. And that's where, all those analytical tools that we've been discussing come in. We need to look at the company's financial statements, calculate those key ratios, and try to determine, its intrinsic value, what the business is truly worth based on its earnings potential and its assets.
Okay, so let's say we've done all of our analysis.
Yeah.
And we actually believe that the company's intrinsic value is significantly higher than its current stock price.
Yeah.
Does that mean we should automatically buy it?
Not so fast. Remember Graham's emphasis on the margin of safety?
Oh, right.
We need to be realistic and consider the possibility that maybe, our valuation is a bit too optimistic, or that unexpected events could occur that could, impact the company's performance.
So even if we think a stock is undervalued, we should still aim to buy it at a price that's even lower just to give ourselves that cushion.
Exactly. You can think of it like buying insurance for your investment.
Okay.
That margin of safety helps protect you from those inevitable uncertainties of the market.
That's a great analogy. Okay, so what about situations where a company's stock price seems completely out of sync with its fundamentals? Like, what if a company is generating solid earnings, has strong financials, but its stock price is just kind of like languishing?
That's where things get really interesting. And this is where I think Graham's philosophy can really shine. So remember, Mr. Market is driven by emotions, and sometimes he gets overly pessimistic.
So there might be times when the market is undervaluing a company that's actually pretty solid for reasons that have nothing to do with the business itself.
Precisely. It could be due to broader market trends, negative sentiment toward the industry, or even just plain irrational fear.
So if we've done our homework and we believe that a company is genuinely undervalued by the market, that could be like a fantastic buying opportunity.
Absolutely. It's kind of like finding a hidden treasure that everyone else is overlooking because they're too focused on, that short-term noise.
Okay, I'm really starting to see the power of Graham's approach. But what about the opposite scenario? What if a company's stock price is plummeting? Like they announce a string of disappointing earnings, or they face some unexpected challenges. What should we do then?
Yeah, that's where discipline and emotional control become really, really crucial. The first thing is to avoid panicking.
I mean, that's easier said than done sometimes.
I know, right?
Yeah.
But you have to remember, we're not trying to time the market. We're trying to find undervalued businesses.
Right.
So if a company's stock price is dropping, we need to take a step back, take a deep breath, reevaluate the situation, and figure out if the decline is justified or if it actually presents, a buying opportunity.
So it's not about just like blindly selling off our shares just because the price is going down.
Exactly. If the company's underlying fundamentals are still strong and the long-term prospects are still intact, that price decline might just be, a temporary blip.
Okay.
In fact, it could even create a chance to buy more shares at a bargain price, which could, increase our potential returns down the road.
Okay, so we need to be discerning. A falling stock price isn't always a signal to sell. It might actually be a signal to buy more if we think the underlying business is still solid.
Precisely. And that's what I find so compelling about Graham's approach. It encourages us to, think for ourselves, to be patient, and to focus on that long-term value of a business rather than getting swept up in those, short-term fluctuations of the market.
This has been such an eye-opening deep dive. We've covered so much ground from, understanding market dynamics to analyzing financials, evaluating management, and even navigating, these real-world investing scenarios.
Yeah, it's been a fascinating exploration. And I'm excited to see how we can all apply these principles to our own portfolios.
Absolutely. So for all of you listeners out there, I really encourage you to continue exploring the world of intelligent investing. Read How to Think Like Benjamin Graham for yourself and start putting these principles into practice. You might be surprised at the insights that you uncover and the opportunities that you discover.
And remember, becoming a successful investor is a journey. It's not a destination. Be patient, be disciplined, and focus on building a portfolio of undervalued businesses for the long term.
Thanks for joining us on the Deep Dive. We'll see you next time for another fascinating exploration into the world of knowledge. Until then, keep learning, keep growing, and keep diving deep.